Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take your stock-related questions tonight, Chantal Marx from FNB Wealth and Investments, Willem from Nitrogen Fund Managers. Please be sure to send your questions on email, stockwatch@bdtv.co.za or SMS 41392 or on X using hashtag Stockwatch. Chantal, Willem, appreciate the time today. Chantal, let's kick off with you. We had some Barloworld results. Nice debt reduction, HEPS lower, lots of moving parts. Your thought on the numbers and the opportunity in the stock, if any?
Yeah, so I think that the numbers were more or less in line with expectations. We knew that things were tough in the equipment business, particularly in South Africa. That's just a function of lower capital expenditure by some of the bigger mining companies. And then we knew things were going really well in Mongolia. So absolutely no surprises there. I think the opportunity here is a recovery in the mining capex cycle, firstly, and then secondly, potential corporate action, although I don't really understand the structure that has been potentially put forward around a takeover of Barloworld.
Yeah, with the Saudi Arabian shareholders, CEOs, and all sorts. Willem, your take on it. There's also it was Barlow who had the challenges with Russian sanction busting and sort of confessed to the US authorities, but we don't know what that means either.
That is correct. So I agree with Chantal. The corporate action on Barloworld is still very much up in the air. The BIS investigation into the Chinese operations is incredibly frustrating, and the timing around it was also, I'd say, suspicious in the middle of the sort of deal cycle of the 2 or 3 cautionaries. The operating results, Mongolia was good. We have to see sort of where that will go in the future. And South Africa is a lackluster sort of business piece, but it's two tail risks. It's the BIS investigation and the potential buyout by the combination of management and Zahid Chakza in Saudi Arabia, which to me doesn't make a great investment case. I think at 90 Rand, you're sort of well poised between sort of a big sanction or some sort of tariff imposed by the US and the buyout coming out in something like, let's say, 110, 120 Rand for a Barloworld share.
Yeah, I take your point on that. Well, let's stay with you. Sasol, weirdly, it hasn't been on the show, well, not when I've been on, for a week or two, but there are a lot of folks out there who love it, but there are a lot more who hate it. The stock's been under pressure. Would you buy, sell, hold, or run for the hills?
I definitely say it's a sell. Sasol still remains the same investment case it has been for the last year or so, which is a very high sort of capex requirement with very low earnings potential. And we saw over the last 6 months from the last result that even at high oil prices, their spreads on their business doesn't satisfy the costs that it takes. It's also a very inflationary sort of cracking method. The whole Synfuels business, which we forget, it competes with oil refineries that spend one amount of capex and then uses that refinery for 10, 15 years, where Synfuels, the process is inflationary. So long term, it's a very difficult business for them to keep up with. And unfortunately, at the moment, the sort of storms don't stop, which means the LCCP cracker isn't valued well by the market, as well as the sort of local chemicals business is in a poor pricing environment, which again means there's not a lot of upside and quite a lot of downside regarding the ESG aspects of Sasol as a business.
Yeah, and those ESGs around Secunda. Chantal, Sasol?
Yeah, I mean, I won't be looking at Sasol at the moment if I weren't a holder of the stock. And if I were a holder, I'd seriously reconsider my position. The reality is exactly as what Willem painted. And I think you do have some upside potential if we start seeing a meaningful improvement in global chemical prices. But I don't see that happening in the immediate term. And while we are waiting for that, there are substantial operational risks that continue to play out. So just as you start thinking refining margins are starting to improve, there's an issue on the mining side. And this has kind of become commonplace for Sasol. So to me, it's still an avoid.
Okay. What about WeBuyCars? We had results out last week, on the week that was on Friday. You said it wasn't too bad. It has doubled in price. There's actually, we were saying before we went on air, there's been some good movements, some stocks over the past year. WeBuyCars now trading 42 Rand.
Yeah, so what's been interesting about WeBuyCars is that the earnings growth outlook has actually kept up with the market valuation, which means that it still doesn't look expensive if you consider a forward P of about 15 times for a company that's giving you between 20 and 30% earnings growth over the next 3 to 5 years per year. So, I think the used vehicle space in South Africa has been ripe for disruptions. This is the disruptor. It's a very fragmented market space, which means it's easy to gain market share. And their operating model makes sense to me. So I'm still very happy with WeBuyCars, and I don't think it's too expensive to get involved.
Willem, I mean, certainly, it's about 5% market share. The used car market experience has never been a good one. Anyone who's tried to buy or sell one, they do change that game. At 42, is there still some value there?
Yeah, the business model and the business case is incredibly good for WeBuyCars. I agree with Chantal. If you look at a 15 times P and a 20% growth, most 20% growth companies would trade at 1.5 PE2 growth rather than a discount to their growth rate. So in terms of valuation, if they can deliver on their promise and their strategy, which they have done and demonstrated over the last sort of 5 to 10 years, even while they were part of TCP, long before they were a listed own entity, there's lots of room for growth. And with 5% of the market share, there's no reason to doubt that. So I'd say at least a hold and potentially sort of, not necessarily a buy, but any sort of dip. It's a strong stock with a strong business case with lots of growth ahead of it. Definitely a good investment opportunity.
You mentioned TCP because the question came through around WeBuyCars. The second part of the question was what to do with my transaction capitals that I have, which, I mean, if my sense is we take SA Taxi, make it zero, and then it really is the Newton business. Willem, is the Newton business attractive? Is what's left in TCP looking good?
Newton's a great business. As far as I understand, there is a deal on the table that's been signed. It just hasn't been implemented. So the total value of Newton probably is reflected in the live transaction capital price. In terms of a recommendation, what to do with that stub, it would definitely be a sale. Even though the SA Taxi is ring-fenced, you're left with a business that you probably didn't really want to be invested in any case. And you've done very well if you just held your WeBuyCars as it came out of TCP. So in my opinion, there's no reason to hold on to SA Taxi and Newton. It's an interesting business, but it's small. It probably doesn't deserve to be listed. So you could potentially say there's a chance of a buyout or a delisting from management. But overall, there's no reason to stick to that. I don't think that was ever the investment case for TCP.
Chantal, what's left in TCP? I mean, once a high flyer, once it was all about SA Taxi, that of course has changed.
Yes, it's absolutely changed. And now they're trying to basically reduce that exposure to SA Taxi, move away from that completely. They're looking to rename the business or the transaction capital business Newton. And that is what it will be trading under going forward. But as Willem says, it's going to be a really small company if it remains listed. Whether or not the investment case is there, I mean, I see the potential for long-term growth in the market that they are in. They've done really well in terms of their debt collection business, and then in customer experience, we know it's a growth area from a South African industry perspective. Obviously also quite fragmented, so the opportunity once they have a better balance sheet footing to perhaps make some really good earnings accretive acquisitions going forward. But it's going to take a while to see whether or not they can get to critical mass in that business. So for now, I'd also just stay away.
Yeah, okay. Stay with the WeBuyCars, leave the transaction capitals to itself. Chantal, staying with you, we saw Netcare results out earlier this morning. The question coming through was around Life Healthcare versus Netcare. Is either attractive at current levels?
So I think both are kind of decent, solid businesses that will give you a kind of okay long-term growth, because you do have the possibility of a reignition of economic growth in South Africa, and that could in turn drive medical aid memberships over the very long term. They could also benefit even from an NHI scenario because occupancies will be higher, but they're never going to be super exciting businesses to own. So you need to look at what your requirements are as an investor and then make that decision. I prefer Life Healthcare over Netcare, just for the simple reason that there is some optionality in Life Molecular Imaging. They're doing some really great work in terms of the diagnostics that they make available to diagnose Alzheimer's, which we know there are gains being made in the treatment of that disease. So diagnostics becomes very important.
Willem, Life Healthcare versus a Netcare, what is a shrinking sector on our JSE?
That is correct. I mean, those are two mature businesses in a saturated market. So you have to think the NHI would be positive, which there are two sides to that argument. And even if it is, that's a very long-term sort of scope. So your growth in earnings, if you look at Netcare this morning, was about 6% with PPDs. They keep PPDs kind of flat, around a flat number, and patient days along with hospital days, apologies, are not changing. So the growth is almost inflationary, which as an investment, it's a good stalwart for portfolio, but it's not exciting. And there's no near-term catalyst to change that story around Netcare and Life Healthcare and Mediclinic in Reunert for that matter. In terms of the choice between the two, sorry, Simon, in terms of the choice between the two, I agree with the whole Life Healthcare story and the growth from the Alzheimer's potential screening. Regardless, it's not an easy investment, and it's a long-term sort of, we're not sure exactly what the NHI holds or where that industry is going.
So you both made the point that neither are exciting, neither have great prospects. Then is Discovery, Willem, let's stay with you a second. Does Discovery then stand up to the plate, or is that perhaps a higher risk for NHI because of their large component around medical aid?
Yeah, Discovery it's such a large business with so much growth potential and such a strong management team. They're looking to roll Vitality globally, or at least in the markets where they are globally, along with the fact that the bank taking all the customers from Vitality into the system. So the whole ecosystem as a client is very impressive. The targets management set for themselves are also equally impressive. If they were to follow through on 20% ROCE sort of targets, that's a great investment. And insurance in South Africa, not just medical insurance, car insurance, the banking business, have all been performing well, whether it's just a two-pot system leading to sort of payments of debts, or it's South Africans being positive about the GNU. The overall market, as investors and the market as clients, has been very well supported, and I think that stays a great business long term, just because of the management team and the way they deal with their sort of potential market.
Now, Chantal, your take. I mean, there's certainly, things have been clicking. I mean, the bank is hitting its targets, a year and a half ahead of when they expected to. Discovery in your books?
Yeah, I mean, if you bought it when the NHI bill was signed into law, you would have made 150% off of that trade. So it certainly isn't a cheap business at the moment. I think that's my only concern around Discovery. It's not cheap. And then there's always been question marks around the way that they account. And I think that is potentially another risk for them, as is the implementation of NHI. But it is an exciting business. They've diversified well outside of just the medical aid business. There's a lot of offshore growth potential there as well, and they're incredibly innovative. So there's no reason why they won't be able to adapt to an NHI scenario. I'm sure they already have so many plans in place around that. Even if it happens or not, I'm pretty sure they'll show some decent growth. As I just said, I think it's a little bit expensive at the moment.
A question was coming through around Boxer. We didn't get a much more, Chantal, we'll stay with you, insight today, except that it is going to be at 54 Rand. It is going to list on Thursday. Probably no one got as much as they wanted. And we will get more details when it starts trading.
Yes, heavily oversubscribed. I mean, from an F&B stockbroking and portfolio management point of view, we are going to explain to our clients why they're getting a teeny tiny allocation of what they applied for. But I think that was expected. There was a lot of interest prior to the offer being announced, and the offer range was very, very fair. So they're not trying to do investors in, and by extension, you would have seen a lot of interest. I think the 54 Rand is very close to our fair value of about 52 Rand, and we are very conservative in our assumptions. So, I mean, if they are able to push through the kind of growth that they're expecting to push through and persist with that store rollout, and the excitement remains, there's no reason why the stock can't trade at around 60 Rand. So very exciting times. It's listing on Thursday, and I'm looking forward to it.
Willem, is the play here to chase it on, assuming that no one got the allocation that they wanted, anywhere near the allocation, is the play to chase Boxer, or perhaps to pick up some Pick and Pay, who still own over half of Boxer and now get 8 billion to pay down debt, and they've got Sean Summers promising all sorts of things?
That is correct. So until it trades on Thursday, there's no way to tell. If it opens below 54, everybody would be able to fill their own allocations.
Sure.
But given the oversubscription and the current shape of the market, that the potential for that's pretty small. Pick n Pay, I agree, own 65% of Boxer, and they get 8.5 billion rand to clear out the problems. And in the future, Boxer will be taking over loss-making Pick n Pay stores, as they have done in the build-up to the IPO, which means the payoff for Pick n Pay is almost double. They'll get rid of a loss-making Pick n Pay superstore, and they'll add a potentially profit-making Boxer store. I agree with Chantal. 54 rand is definitely not the top for Boxer. The potential growth is 15-20%, which is something like a disc scheme listed at a similar growth rate and is trading at a 25 to 30 times earnings multiple. So taking all of that into account, I could even make a case for a higher target price, maybe 65 or 70 rand 1 year out. So in terms of chasing it, yes, at the right price, maybe around IPO or below. But after that, I would agree with you, Simon. Pick n Pay makes more sense at 28 rand with a 65% stake to Boxer than in chasing Boxer up to 60 or 70 rand.
Chantal, would you chase Boxer or would you go the Pick n Pay?
So, I mean, the Pick n Pay story is there's just a little bit of risk there, right?
Sure,
because
sure.
you do have the payoff from the Boxer listing. You do have the balance sheets looking fantastic after the Boxer listing, but the reality is that the Pick n Pay core supermarket business is still loss making, and it could still be loss making for the next 2 years. So you are betting a lot on that turnaround. You do get the exposure to Boxer, but I think that outside of Boxer and perhaps Pick n Pay clothing, the investment case looks very murky. So my preference would be Boxer. I just won't chase it at any price, because we saw what happened with this game post their listing, right?
Yes.
Investors were chasing it, and then it went absolutely nowhere for several years.
Yeah, no, I take it point. And Sean Summers is promising us everything, but promises with respect to Mr. Summers are sometimes a little bit easier. Sean, staying with you, Invicta results out. Probably about as a boring a stock. Actually, my next question is even a more boring stock in many ways. Not bad results. The rand is hurting, but it really is. I mean, Stephen Joffrey and his team, they kind of stick to their knitting, and they run a good operation in a tough time.
Yes, so I mean, I put that the Invicta, Udeco, Reunert, all of them are kind of in the same basket for me in terms of boringness as well as in terms of the investment case. And I think when you start seeing a fundamental shift in business confidence in South Africa, and you start seeing some proper go forward expansion, these are the types of businesses that will benefit from that. I think that there's obviously differences between these businesses specifically, but from a valuation perspective, they all still look pretty interesting to me. And Invicta is no exception. You would have also done well on Invicta on the SA Inc. Trade, but I think that it's one of those stocks that still has further upside potential, particularly when you're looking for SA Inc. and you've seen the retailers run as hard as they have.
Yeah, fair point. The retailers have got completely crazy. Willem, Invicta?
I again have to agree. I think in terms of South Africa, the small cap space is by far the best valued, partly because of the small cap and the low liquidity. But in terms of holding a stock for the medium term, in terms of investing your money in a company for the medium term, the ratings these stocks have, even after the re-rating post-GNU, is incredibly low. We're talking high single digits, sometimes low single digit multiples. I think in Invicta's case, it's high single digits, but that's half the JSE, and that's a quarter of an S&P 500 multiple, which means the value is glaringly obvious. There's no immediate excitement or upside, but in terms of an investment to hold for the medium term, they are good stocks and they are great foundational portfolio builders. I like all of them.
Then the other boring one was Reunert, which Chantal alluded to. Willem, let's stay with you a second. Results were out. They've got the cabling division looking nice in a good space. They've got defence looking great, again in a good space. They've got office, which is Nashua. They had challenges in the first half at ports. They've resolved that. Your take on Reunert?
We like Reunert as a stock. It's a fairly big holding for us. Again, for the same reasons we've said, it's been a good stock for years, and they've had lots of exposure to the defence spend as well as the overall transmission and distribution of electricity in South Africa, which, even though it's not necessarily from Eskom's side, is still a growing business and it still has a lot of demand. The management team are very conservative in terms of the guidance, but at a stock trading at 7 times multiple with 10 to 12 times growth, it's hard not to like. And the performance has been consistent over the last 2-3 years, with potential. If for some reason global tensions escalate, they are exposed to that. That's a catalyst. If Eskom or any sort of other power distribution or generation or transmission service becomes required, due to the GNU, they are exposed to that, and their track record speaks for itself. There were some hiccups in the last results, one or two line items that were below expectations, especially in terms of compensation, and one or two businesses that did not perform. The plans, they are good, and they struggle to execute in difficult times, but overall the growth is good, and I do like the business and the management, and the rating is completely too low.
And Chantal, looking at that chart there, the stock's up a third in the year, this year alone. So I mean, we can call it boring, we can call it lots, but it's doing well. Your take on Reunert as an investment opportunity?
Yeah, I mean, it's like I said, with that entire basket, you've got the stock up 30% over the last year, but you've got Mr. Price up 150% over the last year. So comparatively speaking, it just offers so much value, and it has exposure to the same sorts of dynamics from a broader SA Inc. space. Yeah, I mean, there were some hiccups in the last set of results, particularly relating to renewable energy. I just think that the supply chain was a bit filled up. And that resulted in them holding way too much inventory, and demand not really coming through because that inventory was quite high within their sales channels as well. But yeah, I mean, cash generation has been very strong for decades. They also pay a really good dividend. So you're looking at a dividend yield of in the high single digits as well. So even if you're waiting for the re-rating, you'll be compensated quite nicely with cash returns.
Yeah, actually, I'd forgotten that they were quite chunky on dividend. Now going from the small to the large, although not as large as it used to be. MTN question coming through: hold or sell? Chantal, MTN, hold or sell?
I'd still hold MTN. So what we've seen in the last year or 2 years is massive foreign currency depreciation in some of their largest markets, including Nigeria. That has had a very negative impact on their translated earnings and revenue, and also a negative impact on their cost base, because their costs in Nigeria specifically was mostly in US dollars. They've seen what a big impact it has had, and they've actually renegotiated a lot of their tower leases to be linked to Naira CPI rather than US dollar inflation. So I think that is going to be very positive for them from a consistency perspective and just from a planning perspective. And I also think most of the heavy devaluation on the African currencies have probably reached a peak. So we'll continue to see those devaluations, but probably not at the pace that they've been at. And in local currency terms, this business is still growing. Demand for data is still growing. Smartphone penetration is still growing. And the fintech side of the business is also very, very exciting.
Willem, MTN, I mean, it's been tough, but I take Chantal's point. Maybe, certainly the devaluations is behind them. Would you be looking to hold or sell your MTNs?
Yeah, definitely hold. I think the share price hasn't performed at all over the last 6 months to a year, and that counts for all local listed telcos. Locally, it's a saturated market, a mature saturated market, which is incredibly difficult to sort of get market share without sort of cannibalizing yourself or starting a price war, which would be detrimental to all the players. In Africa, again, same thing, same sort of business scape for Vodacom and MTN. MTN has the Nigeria Naira parallel rate, which has been an incredible sort of headwind. But what MTN does have, which none of the others have, is the fintech business. And I think if you had to make an investment case for your hold, it would be around MTN's fintech business. Whether or not they can capitalize on it, the promises are big and the guidance is promising. If you can believe management and believe that they can pull through, that is the telco to buy out of all of the listed telcos. I think above Telkom, above even sort of Capitec's offering, above Vodacom, but it relies on a promise, which is a risk. So a hold is an easy call.
I take your point. Let's go to some stock picks, Willem. Super Group, the announcement out from them today. I think they're getting offered $3.50 Australian for their SG fleet. Super Group, you pick.
We've been speaking the whole night about value over growth. With Super Group, we tend to forget how the rump gets valued. SG Fleet makes up about 75 to 80% of Super Group, which means on a PE basis, even though Super Group looks on the JSE maybe a 6 times multiple, the rump's trading at 1.5 to 2. Now, these are businesses. It's SA dealerships, UK dealerships, it's a supply chain business in Africa, and it's fleet management in Africa, but are trading at 1 to 2 times forward earnings. And I think a deal like this, even if it does not come through, just reaffirms the fact that Super Group is an incredibly cheap business. One times earnings is impossible. If the deal comes through, Super Group has 20, 30, 40% upside to get your 3 PE. Again, compare that to Motus or CMH. The value is undeniable. So for me, this deal this morning is just a highlight, or just reaffirms the good parts of the Supergroup business and the incredible cheapness of the rump ex-SG Fleets Australia.
I take your point on that, Chantal. Mondi.
Yes, so Mondi's been a very disappointing performer over the last year or so. It's a pretty stable business, but with really strong kind of growth markets that they're feeding into. I mean, sustainable packaging and corrugated boxing, I think from an e-commerce and an ESG perspective, will be well supported going forward. They're vertically integrated, so they own almost the entire supply chain. They've recently made a really solid acquisition that will see their footprint increase further, particularly in Europe. And then you have them having exited their Russia business recently and the market not reacting to it at all.
Yeah.
I think it's a core portfolio holding. It will give you decent growth over the long term, definitely a long-term core year because momentum on the share price still remains quite negative. But you'll have a 5% dividend yield in hard currency terms to tide you over while you wait for the re-rating.
Yeah, I love that. Dividends paying you while you wait. We'll leave it there. That's all for tonight's Stockwatch. Thanks to our guest, Chantal Marx from FNB Wealth and Investments, going with Mondi, Willem from Nitrogen Fund Managers, going with Supergroup. Up next to close, stay tuned.